Hey everyone, this is Rob Keens at goldsilverpros.com. We're recording this Wednesday, April 7th, 2021. And I have a very special returning guest to the show, James Anderson, Director of Content for SD Bullion. James, how are you doing today?
Good, Rob. Thanks for having me on the show.
Yeah, absolutely. So thanks for joining our conference back in January. I know that you gave a presentation on, when to sell your gold and silver. It's always very interesting to outline for investors exit strategies on how to get out of the market, because eventually they may want to sell some of their holdings or all of their holdings. So thank you for that presentation. If people want to see that presentation, it's up on our website, goldsilverpros.com/solutions-2021. And we can also provide a link down in the description as well. It's a great presentation. Since we have talked about that during the conference in January, a lot has happened. And I wanted to start off with something in the stock sector. We have seen an absolute blow up of Archegos. And there's a little bit of history to this firm that I wanted to highlight for our viewers. And then I want to get your opinion on some things having to do with that. So we're going to share, and we're going to go over and look at what the Wall Street Journal has reported for this. It's pretty fascinating. So I was reading this Wall Street Journal article, and they were talking about the history of the gentleman that ran it. So essentially, it was investor Bill Huang set up a storm with his firm Archegos Capital Management. Banks began liquidating huge positions. But here's the key piece right here. So this is, he's a former protege of a hedge fund titan, Julian Robertson. He was called a Tiger Cub. They had one of the biggest Asia-focused hedge funds. They ran into trouble. They paid $44 million to settle a lawsuit for criminal fraud charges in Asia. Then he rebranded it to Archegos Capital and brought it over to the Western markets and hid his involvement. There's more in the Wall Street Journal article about this, but hid his involvement through hiding his stock ownership through other means. In any case, they basically pulled the same thing. And at the end of the day, they were managing about $10 billion worth of funds. But through leverage, this is a big leverage stock investment, they were controlling 30 billion. So this sounds a lot to me like the COMEX, for example, where you get into a futures contract with a little bit of money, or the Forex market where you get into a Forex position with a little bit of money, but you control, a bigger swath of money. And when that investment goes down, you get margin called. That's essentially what happened from Archegos. And one of the fallouts is, it looks like right now, Zero Hedge is estimating between $4.4 and $5 billion loss for Credit Suisse, which is a major international bank, as a result of Archegos and some other bad decisions they made with a company called Greensill. So if you guys, we'll put these links down in the description if you want to follow it. But we're talking multi-billion-dollar losses for mistakes made by Credit Suisse in relation to Greensill and also Archegos. One's a British firm, one is an Asian firm. So a lot there. And my question for you is basically, what's your knowledge of what's going on with Archegos? What are your thoughts on that? And how do you feel about investment in the stock market right now?
So from what I've gathered thus far, and just looking at the story from the periphery, and I've just listened to a recent podcast with Grant Williams, Ben Hunt, and a few other guys, Peter Fleckenstein and others were on a podcast talking about it. And just, also Scott Menard, a big silver bull out there, was saying that this won't be the last explosion of levered hedge funds. And that's, I think the ultimate point is the fact that this is probably going to be bigger in terms of the size of it and the scale of it. We're only probably hearing, a fragment of what's really happened. And the other thing is the questions that are being asked and the story that's being told doesn't make a whole lot of sense. I think there's more to the story. And so, maybe we'll find out months from now. But ultimately, it just seems like we have a situation where there's a huge amount of leverage being used in the stock market at all-time highs. And these guys are like net long, and which is pretty insane. And you just have like not much transparency in terms of who owns what. And it looked like in this situation, it was like they were owning major stakes in companies, like a third of the company was owned, but it was through a derivative pool. So they didn't know that a third of the company was owned by this fund, right? And then it went wrong on them. And now all of a sudden, some bag holders like Credit Suisse are out, 5 billion or whatnot. We'll see. But Credit Suisse last year had like two billion in change in net revenue in terms of profits. So it's like multiple years of profits for them in terms of the way that their bank works. So I mean, it's a real legitimate problem. And Credit Suisse is a big bank. It is one of the globally systematically important banks as defined by the Financial Service Board, or the Financial Stability Board, which is a BIS offshoot. Essentially, the FSB runs around and says which banks are, if they fail, are too big to fail. Essentially, if they fail, it could mean a real threat to the entire way that this financial system operates and whether or not it can function. So it's a big deal. I mean, we don't know necessarily how this will play out, but I mean, if dominoes keep continuing to fall, you could have a situation where this financial system freezes up. I mean, it is that kind of scale and size that we're talking about. If a Credit Suisse or a bank of that size fails, what does that mean in derivative markets? What does that mean in terms of bets that they've made, or other banks have made, in terms of dominoes falling? And so, yeah, it's risky. The worry about the stock market, I think right now is it's difficult not to be involved because of so much currency creation, so much printing going on. And you look at the last 5 years or so of how stocks have performed, and it just seems like, yeah, I mean, stocks only go up, really. It seems that way. And so it's difficult not to partake in some of the dumb, easy gains that appear to be, have occurred. But what's happened in the past is not necessarily what's going to happen tomorrow. So you kind of have to be careful in terms of what you're owning and the risks that you're taking in the stock market, I think right now with the prices and the values that it's at. So yeah, it's for me I'm majority bullion position. I'm actually irresponsibly positioned in bullion. And that's because I think bullion shows actual real value in terms of the next 5 to 10 years versus the stock market or the bond market, et cetera. And so that's mainly why I focus in bullion. But I do own stocks, and there are shares of companies that I own. It's not a huge percentage of my portfolio, but as time goes on in the future, I likely will go back into the stock market because America, everything is set up for the stock market. It's just the way that the laws are working and the way that they want investors to be involved. The unsecured stock market is essentially where they want the retail public to be. And so in not engaging that, you can miss out on some gains if you get in, if the timing is incorrect. So what I see in the future here, Rob, I just think that we're going to go through another situation where it was like the late 60s Nifty 50 era into the 70s, where you'll see the stock markets nominally stay high and propped up, I think, because the Federal Reserve is going to keep doing that with the passive investing. They can prop the market up nominally, but in real value terms, I think it's going to lose a lot to bullion in the next 5 or 10 years. And then it'll be time to probably transition back towards stock market and as you go into the 2030s and beyond.
Yeah, I agree with a lot of what you said. And I wanted to approach this also from another angle. When we were doing our Cowboy Metals live stream this week, we had a question from one of the people: is this the Black Swan? Because Credit Suisse is going to be taking a $900 million hit in this quarter, and we think it could be $5 billion over the next few years. Is that enough to take down Credit Suisse? And if so, what are the reverberations around the rest of the banking system? And is this the Black Swan that people have been talking about in terms of the next financial collapse, do you think?
Yeah, I think the next financial collapse only happens when the too big to fail banks are allowed to fail. When the actual politically, the real power behind these banks says, okay, now it's time to actually let this system collapse, and let's use this crisis and chaos to build out the new system. And I'm not sure we're at that ready point yet. I think in order for the next system, you need the fiat CBDC grid to be fully in place, ready to go, for intra-national power, right? So in terms of like Chinese yuan is obviously coming very soon, but the Bank of England wants one, the euro wants one, the fiat Fed note wants one. All these different grids of power in terms of the ability to control and track and trace internal money flows. I think all these governments want that. And in the next system, that's a key part of what's coming. And then I think the next other side of it is too, the international, the supranational situation is with the IMF and the SDR and likely the MSDR bond issuance. And that will, I think, help supplant a lot of the US Treasury plumbing that happens in the financial markets. I mean, the US dollar is still going to be involved. Don't get me wrong. It just won't be 60% like it's been, it's been dominating the last decade or so. It's gone down a lot lately, but in terms of reserve currencies, it's still super dominant, 60% of the total, funds that are held by governments and central banks. So I think in the future, you'll see that slip down to 40, 30%, and we'll be going into a high inflationary period with the fiat dollar, kind of like the fiat sterling happened after it got off the gold standard and lost its dominance in the reserve currency realm. I mean, they went through huge inflation in the 70s, and I expect a similar rhyme of repeat for the fiat Fed note to come.
Okay.
But
and you brought up
the
situation. That was also one of the questions in our live stream earlier this week was how does the $650 billion of SDRs affect, and I think you mentioned it could replace the Treasury. So could you explain your thoughts on that a little bit in terms of how the SDR may change that?
So the MSDR is what's been pitched as being the private bond system for the SDR. And MSDR essentially would be a breakdown of all the major blocks and currencies that are in the SDR. So you'd have 40% being the fiat Fed note, some 20% I believe is in the euro. And then you have the Chinese yen or Japanese yen, the Chinese yuan, and the British pound sterling. All 5 of those I think are involved. There may be one other, maybe the Swiss franc if I'm forgetting, but those are the major currencies involved. And that what I think they're trying to do is they're trying to kowtow to China, because ultimately China is where the IMF headquarters is going to move to by the end of this decade, likely, because China is dominating in terms of global GDP and trade. And that's by the charter of the IMF is the IMF is supposed to be headquartered in the main #1 economy in terms of gross product, et cetera. And so China is going to be where the IMF is going to be, probably in Beijing. And it pains me to say that, and I'm sure a lot of people in the United States hate to hear that, but that's what's happening. You have Christine Lagarde out there talking in 2017, literally explicitly saying by 2027, her dream is to have the Chinese Beijing SDR branch, the IMF SDR headquarters essentially by 2027. And so, I mean, when I saw that, it shocked me because 10 years is not that long a time in the grand scheme of things. And 2027 now is only 6 years away. So imagine how much change would be if that's the situation we're in 6 years from now. I mean, we'll have gone through a lot of change, I assume. And that's, I think, what's coming. I think they're building out the structure. This what's happened recently with Janet Yellen and the US Treasury, basically diverting and going around the Congress by putting out these SDR issuances this year and next year. I mean, it's like just over $1 trillion in SDR being issued, but we don't understand how much leverage can be applied here, because essentially what's being said is IMF is, you have the green light to go ahead and start levering this up and handing out loans, et cetera, et cetera. So I think that's what's coming. It's just going to be a world where US dollar is not going to be as dominant. And inside of nations, the control grids of the fiat CBDCs will kind of keep people in their place, and you'll get a lot of, you'll get a stipend so you don't go out in the streets and riot. If there's big inflation, at least you'll get a stipend for food, so you'll be able to, feed yourself, and there won't be revolutions in those terms. But I think that's where we're headed, is to a big inflationary time frame where you get a fiat CBDC stipend so you can at least afford some food.
Yeah, there's a whole lot there to talk about. And thank you for your view on the SDRs, because I think that coincides with what we've been talking about also with the digital currencies and also the Belt and Road Initiative. The Belt and Road Initiative connecting 73 to 75% of the world. It's being financed not through US dollar contracts, but Chinese yuan contracts and Chinese debt. So China pretty soon will be the biggest debtor in the world. And as you said, they'll have the most GDP and they'll dominate world trade for about 3/4 of the world. So it makes sense that the IMF would move over to their location. And I think the SDR piece is the piece we were missing, that part of the explanation over how they're going to finance this and make this work. So I think that's a really critical insight, and thank you for providing that. Mm-hmm. Going back to our earlier part of the conversation, when we were talking about the stock market, we're talking about basically a leveraged or a leveraged trade in the stock market that is blowing up Archegos and is having these second order effects on the big banks. We have that same thing in the bullion market. And we've had a lot of noise recently over unallocated gold, unallocated silver. So we've seen reports from deposit holders at ABC Bullion in Australia, the Perth Mint, and now we're seeing something come out today from John Adams on Kitco Pool. So let me go over to that and we'll share screen on that. It seems as though we're having trouble with the unallocated precious metals. Here's the report. John Adams put this out about 21 hours ago. Of course, he follows the Australian markets. He had a reader send to him a note. Hello, John, I just converted 2,700 ounces to physical silver from Kitco Pool. They did not have any 100-ounce bars and only 330 10-ounce bars in inventory. I was getting mixed stories as to if they will have all the silver to back up the entire pool. I did not get a good feeling. The wait to get physical silver is about a year, they told me. I hope this helps to keep people informed about the Kitco pool account. So the Kitco pool account is another one of these unallocated silver accounts. We've started to see the unallocated accounts come under pressure. People reporting they can't convert to the physical, whether it be gold or silver. What is your view on unallocated in general? What are the risks there with having unallocated?
So unallocated is basically an unsecured loan that you're giving to a mint or a dealer. And in that unsecured loan, you're not getting any interest, but you're also not being paid. You don't have to typically pay storage fees, which is like, that's clue one, that if you're not paying any management fees or storage fees, that you are entering into a situation where you're the product. I mean, essentially your cash is a loan to this company, and sure, they'll give you exposure to the spot price of gold and silver. If you come back and ask for your cash back, it'll likely track what the spot price is at that time. But that's only if it's just you. Now, if everybody starts coming back and they're using all these loans, they're basically running a fractional reserve system here. I mean, that's essentially what it looks like, where, hey, look at all these people. They're cheap. They want to be able to have gold and silver exposure, and they don't want to have to pay storage fees, and they don't want to have to deal with it get physically delivered to their house or any of that kind of security stuff. And so they're willing to just give us the cash as long as we'll promise to give them, exposure to the spot price. And so that's basically what's happened here in these different vehicles, and they've been going on for decade plus. I mean, the Perth Mint Certificate program has been around for a long time. I mean, since the early 2000s, I believe, and the Kitco pool, the same story. And I'm not sure about ABC Bullion, how long they've been running that, but look, all three of these, I believe, are simply a situation where you're giving an unsecured loan to a company or a mint, and they're using those funds to operate without having any interest, expenses like they would if they got loans from a bank. And that's really what you're doing. You're running a huge risk, essentially. I mean, I think GLD and SLV are extremely risky too.
Yes, I agree.
But these are like, these are not even regulated companies. Like, I mean, Perth Mint at least has to put a financial statement out every year. And I went and ran the numbers on it recently, and it's not small. I mean, it's like 4.5 billion Australians outstanding in these loans. Okay. And so I would imagine the majority of it's gold promises, but then probably 40% of that is silver. So you're talking about roughly 2 billion in Australian, dollars that you owe in silver spot price exposure. And if these people are trying to convert it into bullion right now, I mean, 2 billion in silver bullion in Australian is still a lot of bullion, especially in this situation with the shortage. So yeah, I think they're in a pickle, because I think what you're having is a run on these unsecured, unallocated systems. And people probably just buy these things and kind of, they turn away and they walk away and they don't pay attention. And maybe every now and again, they'll check the spot price, but that's it. I mean, at least I know in the Australian market, from what John has told me, and it's true here in the United States as well, most gold and silver investors, they don't look to the mainstream financial media to get any news on what's going on in the gold and silver markets. They go to the alternative financial media, and they go to channels like ours to understand what we're seeing and what we're analyzing, what we're thinking. So that's what's happening. The word's getting around, and these unallocated systems are terrible bets. They're just not. They're not intelligent bets. They're risky, and you're the one taking all the risk, essentially, and you're getting no interest for it. All you're getting is exposure to the spot price if you can redeem cash at some point, or the bullion if you try to redeem the bullion. So if I were somebody personally in any of these accounts, I wouldn't sit around waiting for a year or whatever, to get the change into bullion or whatever these promises they're making. I just say, bank wire me my funds, or you'll, that's it. It's simply, how long until I can get my bank wire sent to me and the amount that I'm owed. And that's the key. Just get your cash back and then turn around and buy into something that's more sound and more trustworthy, whether that be physical bullion from a dealer that you trust, or whether it be PSLV. But those are the best options, I think, for people, is not to sit around and hope that a year from now they'll deliver on their word. No, just get the cash. Just get out now before there's a real problem.
Yeah, I agree with you. And I put up on the screen there for a second, and this is from Bullion Vault, and I wanted to highlight what an allocator really is. The spot price, and people always ask me this, what's the spot price of gold? Well, it's an allocated market. It's what you said, the fractional reserve market. It does not reflect the actual physical trade. And that's why the futures market and COMEX and the London spot OTC market are not accurate reflections of the actual demand for the metal. And that's why the prices are often lower than they would be if we simply priced it in terms of demand. But here's one of the risks I really wanted to highlight for people. If you're in any sort of unallocated gold, and I've got highlighted number 4 here, your unallocated gold would be ditched if the bank were in need of cash. So in other words, unallocated gold schemes, they take your money, okay, the gold that they have goes as against the bank reserve requirements. If they need to meet those due to a short-term liquidity issue, a short-term banking issue, take Credit Suisse, for example. Credit Suisse is in trouble. If they had gold reserves, they're not giving you the gold. They're going to use that gold and sell it, and they're going to settle with you later. But what gets really interesting, and to add to your point, they might not even have the cash, because when you're in an unallocated gold account, as illustrated by this article, that unallocated account becomes a claim on the general bank assets. So the only way that if the bank got into real big trouble, say Credit Suisse blows up and people were trying to get their unallocated gold or even the cash for that, if they blow up, you become an unsecured creditor. So you have to get in line between all the bondholders and everybody else to even get your cash, much less the gold that you had.
In a bankruptcy proceeding, the last thing you want to be identified as is an unsecured creditor. That means right. You and the rest of the dupes back there might get pennies on the dollar that you lost, right? I mean, it's look in the bank bail-in game, whichever wins on the bank bail-in bets, by law is first line creditor. They are secured, so they can run into say a Credit Suisse if it fails, and if they win a derivative bet on Credit Suisse failing, they would at least get first dibs on all the carcasses and whatever value is there. And trust me, they would take the vast majority of that. And anyone unsecured in those situations is going to probably have to look to their FDIC or their local insurance branch to try and pay them out whatever losses they probably had. And you know, I mean, you're only in the FDIC. I think you're only insured up to $250,000. So businesses and such that are using Credit Suisse are going to be in a world of hurt. The FDIC, absolutely. You know, they're likely going to have way more cash than that sitting at those banks. So that's the kind of trouble that can come out of this. So look, the amount of leverage in the system is not just simply in the unallocated space in the precious metals, but it's all across the board. You know, currency is so cheap and it's everywhere, and it has the sentiment, it has the feel. If you've read history about how, like, for instance, in the Weimar Republic, how everybody was gambling on every damn thing that was not nailed down. I mean, that's basically what's happening these days. And everybody thinks they're a huge speculator and that they're going to make a 50-bag Bitcoin bet and they're going to, you know, off in Lambo. You know, this is insane times. And I think you need to reverse the way you're thinking in terms of, you know, trying to make 50 baggers and make sure you keep what you actually have. That's the first and foremost thing, is don't take a major loss. And don't be involved with something where you're, you know, unallocated and you're an unsecured creditor. That's the last thing you want to be involved in when we're likely going to go through some real pain this decade.
I agree 100%. And I had a question from a reader that I asked Andy from Miles Franklin last week. And I want to ask you, because you work for a bullion distributor here in the States, and this is really geared toward the retailers. So this comes from Irish Picker. It was on our live stream back about a week ago. And here's his question. And he's asking me, it's like, Rob, what are your thoughts about PM suppliers buying up all the stock? And then when the individual buyer tries to buy, they're told to wait. In the meantime, the very same PM suppliers who bought up everything are pumping stories about shortages, only for them to gain when people are forced to buy at inflated prices. I think the thought here, and there is this lingering thought, and I still get this question, are the retail sellers basically price gouging and withholding inventory? I think that we kind of answered that question earlier when we talked about the run on the unallocated gold and silver, but what are your thoughts on that?
So it's a combination. It's not black and white, it's gray. And that's the hardest thing to explain in real life, the complexity involved. It's not a black or white issue. It goes all the way down from the mints to the wholesale suppliers, the authorized participants, the ones who are allowed to buy directly from the mints, to the retail dealers who they then sell to the retail dealers who then mark it up to sell to the retail public. So if you get in a situation like we've been in the last 2 years, where supply is slightly tightened because of outsized demand, the issues with manufacturing that we've always had in our industry, because this industry does not invest huge amounts, millions and millions of dollars into manufacturing bullion products, because they're afraid, and they're, you know, reasonably proven correct. If you look at how the market works, it's a spike and dive market. You'll have 1 or 2 years of record investment demand, and then you'll have 3 or 4 years of waning investment demand. And if you make huge capital investments in infrastructure to build out, huge amounts of product and such, and then all of a sudden the demand vanishes, you're in a real world of hurt. You're going to lose on that bet. And so what ends up happening is consolidation. We've had huge market consolidation in the last decade in the bullion industry. There are only a few gorillas in the game, and they have huge price discovery power in terms of, ask prices and even bid prices. They have a lot of power over dictating what those terms are. So you have a situation right now, for instance, where the American Silver Eagle, if you're an AP, you can buy it from the U.S. Mint, probably in limited quantities right now. I'm sure the U.S. Mint's probably in between. They're probably going to have their new version coming out soon. But I think right now it's $2.35, right, to get a Silver Eagle, brand Nubian from the U.S. Mint, right? And they're being marked up, $6, $7 more bucks, then sold to retail dealers who then have to turn to the retail public and sell and make a profit and keep their lights on, et cetera. Mm-hmm. So the people who are making the most mint are the APs, the wholesalers in this industry. Now, a lot of people don't like to talk about the wholesalers because they get afraid because they think the retail public's going to jump them and go buy from a retail dealer. But the truth is if you called up one of the major wholesale dealers and you asked them for a case of silver and you're just Joe Public, they'd hang the phone up on you. Politely, they'd say, go buy from retail Joe shop over there and don't bother me with your one case of silver. Don't call me with that amount of demand. In order to do business with these companies, it's word of mouth. People know people in this industry. They know how they operate. And if you're a bad actor, you basically get blackballed from this industry. If you don't deliver on your word, you basically lose your business in terms of being able to do business with these dealers. So it's a case by case basis. People know people. And if you operate correctly and well, then you can usually do business well with these people. But if you're not good with your word, if you bail because the spot price moved and you all of a sudden want to balk on that order and go buy it at a cheaper price somewhere else, you're never going to do business with that place that you just balked on. So these are the types of things that once you're in the industry, you understand. But if you're outside the industry, I completely get it. If you're looking at the prices of bullion right now, and it's still like 30 some odd bucks for most products, and the silver spot price is down at 25, it's totally frustrating. I completely understand. My suggestion would be, if you really don't want to pay premiums for bullion prices, you could go hide out in derivative forms or in closed-end fund like PSLV, and you could hopefully wait and hope that, premiums get back in line later on. Say we get back to $30 or $40 spot silver, I would imagine those premiums will come down somewhat. They won't be as high as they've been of late. The percentage, when you buy into a bullion product and you have basically a 20% rise that's required in that price of silver for you to even break even, that's a tough pill to swallow. Even the fundamentals and all that such, you can talk about that all day till you're blue in the face, but people still value their silver or gold hoard in fiat Fed notes. They still give the fiat Fed note that premium in terms of thinking. It may not be the case 5-10 years from now. You may not be thinking in those terms. You may be thinking in terms of ounces more so. But if we go through a real bad inflation, you might not want to do anything with the fiat Fed note. So I know it's a long, convoluted answer, but the truth of the matter is it's gray, and there's a lot of profit that gets made in these times. And a lot of these dealers have to make those profits because there are years where you go through and you're literally only trading on dimes per ounce just for market share. You're basically treading water, hoping to stay alive so you can get to that next, boondoggle of investment demand. And I think it's like a feast or famine industry, and we're in a feast time at the moment. But it's true though, the silver supply is not deep in terms of retail investment demand. It is definitely outsized, and it blew up this industry at the end of this past January to a tune that I've never seen. That was the most demand this industry's ever seen in such a short time frame. In about 30 days time, it pretty much cleared off all the inventory that was across the spectrum. So replenishing that takes a lot of time.
Gotcha. Good answer. And thank you for that. I appreciate all the detail you provided. I would also add in the point that, going back to our earlier discussion, the spot price is determined by unallocated, and then the futures price, which is almost lines up with spot in the US, is determined by a fractional reserve system of paper. So to be fair, when you have this over demand, the premiums are just reflecting the difference between those paper markets, which have nothing to do with physical demand, and the actual physical demand. So it looks like premiums to silver price. I would argue it's actually closer to what the silver price should be. And that, it does create opportunities, like you said, for the wholesalers. But in reality, we should be having higher silver prices across the board. It's just influenced by the spot and the futures markets.
Historically, when we have outsized premium gap ups like this, last time we ever had anything of this size was fall of 2008. And we had a situation where spot price dipped below 9 and, high eights, and the gold spot ran just below 700. And you had situations where you're selling gold bullion. I sold a gold kilo of like $900 when the spot price was 700. I thought the lady who bought it was nuts. But it was the fact that we didn't have much inventory that day. Literally, we were selling gold kilos. That was like the only gold bullion inventory we had. I mean, you think there's a shortage now. Imagine there's a shortage in gold bullion, not just silver bullion. I mean, that's where we were when banks are failing and people are freaking out, like hair on fire, get me, something that will last, that will endure. They will pay huge premiums for gold bullion too. And that I expect we're going to see eventually. 2008 was the foreshadowing of something that's coming. And I think it's, they say they press time out, but we still haven't gone through that full situation where we're going to have a reckoning. And in that day of reckoning, you're going to have silver squeeze that leads to a gold squeeze. And that, I think, is where we're headed, to a situation where getting bullion anywhere near these phony spot prices is going to be very, very difficult. And you're going to have to pay, a huge premium versus spot to get the real thing fast.
Yeah, I agree 100% with that sentiment. We've been talking about that since I wrote my book in 2009, and I think we are getting closer to that. I think Credit Suisse is one of those canaries in the coal mine. I've said the last two to 3 years specifically, hundreds of times on my channel and in my writings, that next big bank blow up that, like you said, they allow to happen, they don't bail it out, is going to be the start of that, of those dominoes. And then we're going to really see what happens to the gold and silver markets then. And that's when you're going to want to have your position. You don't want to wait to that point. Because if you're the last guy trying to grab a chair when the music stops, you're not going to have one.
I mean, all these levered, unallocated things that we're talking about, all these silly leverage games that are going on in the stock market. And you imagine if we have real bank failures, what's going to happen to these clown show situation? I mean, these things are blowing up when the system's supposedly calm. Just wait until the system gets crazy. I mean, you're going to be running to try and keep your wealth with everything that's not nailed down. This idea of like shunning tangible assets is about as dumb as it could get, when we're literally facing a huge, globally systematically threatening situation where bankruptcies could really, really ruin the way that the status quo, where we have to move into a new system. I mean, we are on the cusp of a structural reset. You could pound the table for a decade plus saying it, but I mean, every day that goes by, we're getting closer to that moment.
That's right. I think we're in 100% agreement on that. Okay, last question for you. What are you working on, or additional information you want to pass along to our viewers, either about research that you're doing, because I know you do a lot of content, or about SD Bullion, if you wish?
Oh, sure. So SD Bullion, I create a lot of videos for SD Bullion on the YouTube channel. So if you have interest in you watch videos in precious metals, just go to the SD Bullion YouTube channel and you can find a lot of the videos that I make. I make probably one or two a week. It's a little bit different format. I don't interview as many people on that channel. I kind of make these things from scratch, essentially, where I basically curate what I find as to be the most interesting information of the week, or looking forward, like this, for instance, that we're looking at right now. Did World Central Bank move to China? That covers a little bit of the IMF SDR discussion that we had earlier. And it's more forward looking in terms of the changes that are afoot. But I think for me as an investor, when I'm looking out, I try and look out 5 to 10 years and try to guess best where the trends are going, so I can kind of get ahead of those and to see where maybe most value might be in the future. So I'm not only looking at what's happened this past week in precious metals, but I'm also trying to look ahead and gather a view for people who come to our channel and give them a feeling for where the world might be going in the near future. So
yeah. And James, you do such a fantastic job of that. You cover not only the precious metals, but you cover the world economy. And a lot of times I'll go through your research and like, man, I've never seen this before. It's such a great piece. There's a lot of hidden nuggets in your YouTube channel and in these reports. And I just wanted to commend them. I learn a lot every time I come over to the website or view your YouTube channel. So I appreciate the information and the time that you put into that.
Yeah, I appreciate it, Rob. I mean, it is a labor of love. It's one of those things where I get into it and it's like, one thing leads to another, and all of a sudden I built this weird web of a video that runs for 10, 15 minutes, but usually inside of it, there's a huge density of information. Yes. I use a lot of charts, and charts are fully packed with valuable data information that could literally, I mean, some of the charts that we cover in these videos run for hundreds of years. So there's a lot of insights in terms of cycles and such that we're running through. And, I appreciate the fact that you appreciate it, because it's not simply just gold and silver specific. Sometimes it's more about just societal trends and the way the financial system's moving. Even politically, sometimes we cover some stuff that, you know, maybe I don't want to, but they're important to do if you want to have a feel for where the world is headed.
Yeah, I agree with you. And thank you, James, for being on the channel. Wanted to remind everybody that's watching our channel, we also have a subscription service called Gold, Silver, Pros, Golden Quarterly, where you can become a subscriber and get our quarterly newsletter. We do an annual mining stock review, which comes out in January. We're going to update that here in April. We're also going to cover the general economy. We also have in the Learn section of our website, Gold, Silver, Pros University, which now has about 38 courses and counting in terms of learning about the economy, learning about why you want to own gold and silver, so on and so forth. So I wanted to point people to that if you're interested. James, thank you so much for being on the channel. We would love to have you come back to the channel on a regular basis because of all the research you do. So I hope we can have you back on.
Yeah, Rob, I'd love to do it. So hope to come back and look forward to it.
So if people want to reach out to you and contact you, ask you questions, or maybe even purchase some metal, how would they go about doing that?
So the website's sdbullion.com, and you could reach me directly on Twitter is probably the easiest way. My handle on Twitter is @JamesHenry, and that's probably the best way to follow me. I mean, day to day, I try and update there, and I'm pretty responsive on that social media, that censored social media channel.
Yeah, awesome. And you publish a lot of great reports and exhibits on Twitter too, so I fully recommend going there. All right, so this has been our interview for Wednesday, April 7th. This will premiere on Thursday, April 8th. Stay tuned to the channel for that. Thank you so much, James. And until next time, this is Rob Keats with GoldSilverPros.com.